Hello and welcome to our channel Investment Ventures. This video is part of our educational series and no stocks mentioned here should be bought or sold without the advice of your financial advisor. We may or may not be holding positions in the stocks we talk about. If you like our videos, please join us on Telegram, Facebook and on YouTube channel. What we have for you today is an educational video on rights entitlement. I faced this question many number of times, so I thought I will make a video on this. So what is a rights entitlement? A rights is issued by a company when they want to raise additional capital from their existing shareholders. And they have a record date in place. They have on the date on which the shareholders existing on file with the company will get the rights. Previously, what used to happen is this used to be sent in paper form in the pre-demat days. So it used to be sent in the paper form, and then if a person wants to subscribe to these rights, he could fill up the form, and the company would issue him additional shares at the payment of a certain amount, including premium. But now everything is digitized and online. So there's a big change on the way rights are subscribed to nowadays. And the most recent case has started with Reliance, where SEBI allowed companies to issue rights entitlement, because previously many companies used to come out with rights and either people were not able to sell it off if they do not want to subscribe to it, or the market was not very transparent. But now everything is transparent on the platform. So how do you trade these rights entitlement, or how do you subscribe to it? First thing is, if you're a shareholder on record date, the company issues you rights entitlement. Now, this is listed on the stock market under a separate ISIN number, and it can be simply traded during that window for either purchase. Someone can purchase your rights entitlement, as well as you can sell your rights entitlement in the open market, or you can even purchase additional rights entitlement if you are very confident about the story of your company. Now, the question is, why would somebody want to buy rights entitlement, or somebody want to sell rights entitlement? So if you are not very confident about your company, you do not want to invest more in the company, or you want to sell off part of your holdings, you might just want to sell off your rights entitlement in the market and cash out the additional premium that's quoting at that point of time. Or let's say if you do not have additional capital, or you do not want to invest further capital into that company, then also you might want to sell it off. Now, what's in it for the buyer? I mean, why would somebody want to buy your rights entitlement instead of just directly buying the shares? Because typically the premium of the rights entitlement plus the cost that you need to pay the company would be equivalent to the ruling share price. But let's take an example of Reliance, when they were the first company to issue rights entitlement. Let's take an example of that to see what happened. So Reliance came out with a rights issue at the rate of 12.57. So 10 rupees is your share price, and 12.47 was the premium, totaling to 12.57. They came out in the ratio of 1 is to every 15 shares held by the existing shareholders. So if you held 150 shares, you would get 10 rights entitlements. There was a payment schedule assigned to it. So Reliance did not want all this money to be given to them in one shot. What they said was, in June 2020, we'll take the first installment from the shareholders who want to subscribe to the rights. So 314.25 was what they wanted at that point of time. May 2021 is when they'll call for the next 25%. And November 2021, they'll call for the balance 50%. So they were giving you a payment schedule. Just like if you're investing in a property, the builder gives you a payment schedule. Now, What happens if a person does not sell his rights entitlement or does not subscribe to his rights entitlement? What happens then? They basically expire worthless. So the person loses the premium, neither can he subscribe to the rights any further. Within that window, if you do not purchase or sell or do not subscribe to it, they will expire worthless. So it's best, if you do not intend to subscribe to it, at least sell it off in the market and make some money out of it. Now let's look at this Reliance case study a little further on why you would want to invest in this. So market price of Reliance at the time of rights issue was around 1450. They came out with a rights pricing of 1257, which gives a margin of about 200 rupees between the ruling price and the rights issue price. When the rights entitlement listed on the market, they were averaging around rupees 200. Now if you look at it, 200 plus 1257 is equivalent to the ruling share price or a little more. So if someone had purchased this rights entitlement at 200, he would have to make this first call payment to Reliance at 314 in June 2020. So he has invested till now a total of 514 in Reliance. The current share price of Reliance is around 2000. So his investment is only 500 till now. Now, the current price of the partly paid up share of Reliance is around 1050. So if I look at the return on investment, the person has already made close to 100% return on his invested amount. Whereas if he had bought the share of Reliance at 1450 at that point of time, he would have got a return of about 30% right now. But a person investing in the rights entitlement and paying the first call money has made 100%. So there's a big difference in the return. And he could have invested, let's say, if he was very bullish on Reliance at that point of time, instead of buying one share of Reliance, he could have invested in 3 rights entitlement and made 3 times the money. So his return would have been 1500 on an investment of 1500 versus making 500 on an investment of 1450 to 1500. Even today, if you were to invest in a partly paid up share of Reliance, because now it is not a rights entitlement anymore, it's now called a partly paid up share. So if you invest in a partly paid up share today, every 100 rupee move in Reliance gives you an approximate return of close to 10% on the partly paid up share. But every 100 rupee move on the Reliance share price, which is close to 2000, gives you a 5% return. So you can see there's a big difference in the returns where if you invest on a partly paid up share or in a fully paid up share. But for caution, also do realize this is applicable on the way down also. So every 100 rupee dip in Reliance will give you a negative 10% return on your partly paid up share versus a negative 5% return on your fully paid up share. That's all we had for you today. We are franchisees for Kotak Securities. If you do want to open an account with us, send us an email at invven@gmail.com or follow us on our Telegram channel and send us a message at invven. If you like our videos, follow us on Telegram, Facebook, YouTube channel. The links will be mentioned in our bio. Thank you for listening and stay tuned for more.